I'll briefly introduce myself and then also what I hope to achieve from this 45-minute session. So I'm the founder of a company called Spaceport. We run two lines of businesses. One is a space sharing exchange amongst educators. The other is in neighborhood activity centers. So as an entrepreneur, I've had the virtue of being involved in several fundraising conversations as an entrepreneur. Prior to that, I was an investment banker where I sort of facilitated transactions between entrepreneurs and sources of capital, whether it was VC, PE, or even family offices. So yeah, when the StrategyConnect team wanted to sort of host this event, I volunteered to moderate this panel. So with that, the flow that I have in mind, if I would first obviously request my two panelists, Varun and Sarita, to introduce themselves. So after that, we will try and just get a sense of what this audience comprises of in terms of how many people are professionals, how many people are representatives of the family offices side of things, how many of you are consultants who sort of either advise companies raising from family offices or advise family offices investing in companies. So, and then we'll sort of open it, we'll ask a few questions to these panelists and then open it to the Q&A for the audience. So with that, Sarita, if you could please briefly introduce yourself, and then I'll ask Varun to do so as well.
Sure. So first of all, thank you for having me and thanking everybody who's joined in. So I come with 1.5 decades of deal making experience across sectors. And I have worked with organizations like Ernst& Young Investment Banking and Bharti Airtel in India. My last job was with Bharti Airtel before I moved to Abu Dhabi. Airtel is a very big brand in India and also Africa. It is the third largest telecom operator globally and is present in 18 countries. So, amongst other things, at Bharti, I got a chance to look at acquisition opportunities in the technology space. I was looking at acquisitions in cloud telephony, IoT, 5G, data centers. We did a transaction in EdTech. So that's how I understand a little bit of technology. And I moved to Abu Dhabi recently. Since then, I've been advising funds, family offices, and corporates.
Varun.
Hey, hi guys. Thank you so much for having me and thank you so much for joining in. So very quickly, so I've been working with the Ashika Group for the last 3 years. The Ashika Group is an investment bank based out of Mumbai, and we've helped the likes of Swiggy, Ola, Rebel Foods, FinanceSphere, and many other marquee technology companies raise both debt and equity. We worked very actively with some of the world's largest funds in terms of QED investors, Avishkar, DMI Finance, Jizalo Capital, and many others, as well as with family offices like the Patni family office, the Salgaonkar family office, the Munjal family office, and many others as well over there. Primarily help them in raising primarily help young startups, especially on the technology side, in raising capital, especially when it comes to equity. And so know about the entire end-to-end process and the challenges that companies face, founders face, as well as investors and family offices. So happy to have a chat here. I think Samarth has prepared a great set of questions. So would love to answer that and also answer any other queries that you guys will have.
Awesome. That's the panelist for you. And if I may just get a general sense of the audience as well. So if you represent an investment team within a family office, please send out one on the chat. If you represent professionals such as investment bank, lawyers, consultants who either work with startups or advise family offices, please respond with a 2. And if you fall into neither categories, please respond with a 3. Awesome. Thank you. So largely 2s and 3s over here. Probably no one, so that's okay. And today's conversation will be centered around the aspect of family offices considering investment in technology bets. So that will be the sub context of our entire conversation today versus the general private equity due diligence kind of a conversation. So with that, let me just open up the round of questions first to Varun. Varun, as entrepreneurs, we have the option of raising money from VC funds. So why do you believe that, or what the advantages that a family office can provide to an entrepreneur vis-a-vis a fund?
Got it. Got it. I think Samar, there's a lot of advantages that family offices can provide to any founder when it comes to the capital that they provide, as well as the network that a family office brings, as well as the wealth of experience that they come with. I think primarily the first thing that one needs to understand is unlike traditional VC investors or PE investors, family offices is more at the end of the fund cycle, which could be around anywhere between 8 to 10 years, as the case may be. And I think that is one of the big benefits that it is to have a family office investing in a founder. The other aspect is when it comes to like the networks that family offices bring, and I think one of the main areas where family offices we've seen add a lot of value is with introduction to large companies and banks. And I think one of the areas, like if someone's building a founder's building a technology company which is going to serve a lot of these large Fortune 500 companies and all, it makes a lot more sense for them to reach to the family office and get a family office as an investor, because it just saves so much time and so much money in terms of converting such big clients, which are obviously much more valuable and profitable for the founders. And lastly, I think there are many more advantages, but the last one I would say is when it comes to like navigating downturns and macroeconomic risks, because family offices come from that background of seeing fund business cycles over the decades. They're much more open, and they have much more sounder advice when it comes to giving advice to founders and supporting them. Even during this time, this funding winter, which we've seen since the Ukraine-Russia crisis, it's not been the VCs who've been supporting a lot of their companies, but it's been family offices who've stepped up and have been writing bridge rounds and convertible checks. So I think a lot of benefits that it is to have family offices as an investor class in your company for sure.
Those are a few very interesting, actually very interesting, important considerations for entrepreneurs. Thanks. Sarith, from your side, right? You've represented the Airtel Bharti group, right? So, when you, or let's say when a corporate group or a family office considers investing in technology, why would you want to invest directly in a company vis-a-vis be a limited partner in a fund?
So when you talk about, from a Bharti context, Bharti comes with a lot of expertise, technical expertise. So for a large group like that, there is an option to invest directly or through a LP. But when we talk about family offices, it's a very different equation. So, I want to lay out three themes for today's discussion in context of family offices. One is family office investment is perceived to be patient long-term capital. I think this is what Varun also indicated, that they don't have a limitation. They don't need to exit in a certain time frame like a VC or a PE fund needs to do. So that's something which entrepreneurs love, and that's why I call it long-term patient capital. So the other point I want to make from a family office perspective, at least my understanding of family offices in this region in the short period, is that they do not have the expertise to make risky bets. Unlike what you were asking me about Bharti Airtel, that's very different. It's a mammoth organization with a lot of technical skills, huge team, a lot of support, big capital. But coming back to the family office context, I think they do not have the expertise to make risky bets. So I would suggest that they stick to, or rather they do not invest in long gestation, highly specialized businesses. And the third point I want to make is that the objective of a family office is diversification as well as wealth creation. So, again, this is coming from a Middle East perspective, largely where families are connected with old world economy businesses, and the businesses are stable, the growth rate is nominal. So, from that perspective, it makes sense to take a bet on moderate risk, moderate return kind of new age sectors. So when I say moderate risk, moderate return, it's still probably high risk, high return, but in the given scheme of things where I spoke about long gestation, highly specialized investments, in that context, consumer tech or e-commerce, these are fairly established, they've been around and people have made returns. So these are the three broad themes I want to lay it out there, and my answers today are going to revolve around this. So your question about why somebody should make a direct investment or through a LP, Bharti can pretty much go ahead and do whatever they want because they have the scale, they have the expertise. But for a family office perspective, I think it makes sense to first go through the LP route, where they can pick a fund with a good pedigree and a good exit history. And as step two, they can look at co-investing. They can piggyback on the expertise of a fund, and the fund can look at governance issues, investor rights, risk, etc. And the LP could participate in in the investing round. And as a last step, I would say direct investment makes sense for somebody who is new to this. I hope I have answered your question.
Yes, thank you. So Varun, you mentioned that a lot of these family offices. Have you seen a separate pool of capital being allocated only to technology investments, or is it technology investments are just a sub part of a broader investment thesis that they look at?
Yes, so I think initially this wasn't the case. Initially, it was part of a broader thesis that they would look at, which would include even some private equity style investing, some real estate investing, some listed equity investing. But I think over time, what they've realized is that tech investments follow the power law, which is that 80% of the returns are going to come from 20% of the returns, and that you're more or less going to lose money on 80% of the investments that you make. So it's better to have a separate pool which is there, so that it also helps you so that when your outside winners gain, you still have some ability to offset some of the tax with your losses. The other aspect is that it's what we are seeing with family offices, that they've realized that for this power law to work, they need capital that is set outside, but it's also they need to keep capital to double down on the winners that they identify. Because tech investing is different. Like once you identify a winner, that winner could be the next Google, could be the next Facebook, could be the next Amazon. We've seen that work. We've seen that work since a long time. We've seen it with Cisco. We've seen it with Apple. So it's not a phenomenon of today that tech investments create outsized return, but that comes with risks as well. And therefore, what we are seeing is that a lot of the early family offices who started this journey earlier have now reached the point wherein there is a separate pool of capital, there's a separate team, there's this everything separately created to manage these tech investments. And especially for someone who's come from maybe the IT sector, who's made money over there, we've seen them the first adopters of this. But now that is also getting translated to other sectors wherein like promoters are realizing that there's a lot of wealth creation that can happen by investing in these companies.
Interesting. So I think you mentioned about sort of slightly different returns and risk expectations from a family office vis-a-vis the typical VC investment. So can you just touch upon two things in a little more detail? One is typical investment horizon and exit expectations, both from a time perspective as well as from an IRR perspective. So for aspiring entrepreneurs, that'll be useful to understand how that differs from between family offices and funds.
So when it comes to, I think, investment horizons, funds, because of the regulations, have 8 to 10 year fund life cycle, and in India, it's actually 10 to 12 years. But typically, everyone wants to start the exit conversation from the fifth year onwards, or even earlier, because that just helps with the IRR. As such, what we are seeing is that they want to see VCs are traditionally have promised and look to deliver a 25% plus IRR, and this is dollar IRR net of fees to their LPs. And they need to do this in this time period, in this window, because now what we have seen, especially with the Indian regulator, is that they're becoming very strict in terms of the extensions that funds have been asking to exit some of their investments. So that is something that I think everyone every entrepreneur who is looking to raise funds needs to realize that exits are going to become very crucial if you're taking VC money, because all the focus of LPs, all the focus of the law is on them. And when it comes to the IR returns, like I said, 25% net of fees, net of dollar depreciation, and also that is the critical part that VCs look at. In terms of family offices, I mean, while the returns can be a bit lesser, around the 15-20% mark, they are also not in this not to make money. They are in this to make outsized money, because they can easily put that money in traditional businesses or sectors that they understand very well and make a lot of returns over there, right? So there is the return expectation is still there, that we have seen it actively. Which the only difference comes is in terms of exits and in terms of the pressure to deliver and exit immediately, that is lesser. So if a VC is having a conversation from year 5 or year 6 about an exit, we'll see a family office be more patient and maybe around the 7-8 year mark start talking about that. In certain cases, we've also seen family offices say that we're happy if you create a cash flow generating business. We're happy that you don't list and you keep giving us dividends. We're more than happy to do that. So I think the big difference comes in terms of the time horizon and the pressure to deliver an exit, more than it comes than in terms of returns.
Sarita, what's been your experience on these two variables?
I completely agree with Varun. And like I said early in the discussion, that it's long-term patient capital, and they have no restrictions on exiting at a particular time. There are no such limitations. So that's something which entrepreneurs love, and that gives a lot of leverage to family offices.
Sarita, staying with you, tech investments, deliver outsized returns the earlier you get in. But what's a typical stage that you see family offices being more receptive to? Is it pre-IPO? Is it Series A? Are they even open to considering seed investments? What's been your sense?
So there are different kinds of investors who are, they are across the board. But if you ask me, I would suggest that early stage is not meant for family offices. And I don't know if everybody agrees with me here, but early stage means, very high risk and very high return. You could get that 100x return we were talking about, but there is a very, very high probability of it turning out to be a dud. So for conservative capital, I would recommend late stage. But again, there are two practical limitations with late stage. So for a pre-IPO or a pipe deal, these companies would look at institutional investors and pedigreed investors. So that opportunity may not be available to a family office. And the second problem will be that the check size. If the check size is not very small, not very big for a family office, then again they are limited to investing in early stages or Series AB. So I would suggest that depending on the check size, Series AB is preferable. So that's what I advise in most cases.
Interesting, very interesting. Uh, Varun, earlier in the conversation, you mentioned in terms of access to deal flow, all of these things, right? So, how can a family office set themselves up to compete with the investment teams, the portfolio management teams that a typical funds have? Are you seeing family offices set up these teams to focus on tech investments?
No, yes, absolutely, Samar. That's a great question because I think the returns are dependent on the quality of the deal flow that comes. And what we often see is that once the winners are identified, uh, founders mostly want VCs and they want larger PE folks to be coming in, and the scope for to get a family office allocation in such rounds becomes very difficult unless someone is adding great strategic value or is writing a huge check. So I think it is very fundamental. What we are seeing is that family offices are setting up dedicated teams already, both in terms of for deal sourcing as well as for portfolio management and even for managing their entire due diligence process and everything. In fact, what we are realizing is a lot of them are also seeing the value in hiring a more mid to senior person to take care of this because if you want an allocation and if you want to be the introduction to the right deal to get invested, you need to have someone who's able to have that network and who's able to spot the right deal. And so that is the reason that we are seeing a lot of family offices hire senior people, mid to senior people to do this work. What we are also seeing is that portfolio management is something where we are seeing family offices get quite active as well. And one of the reasons is because not only because of the value add is, but they're also realizing is that they are able to then also assess how much more capital they can deploy in the startup before it becomes big for them, and then maybe a tiger and SoftBank comes and there's no play for them. So they want to get as much as equity as possible in the upside by being able to talk to the portfolio on a regular basis, even if that doesn't mean getting hands-on dirty with things. The other thing is that what I've seen is that it's creating a positive flywheel effect, wherein a lot of the founders are quite happy with the kind of introductions and kind of help that these family offices are giving them. That they are themselves recommending the newer founders who are setting up that, hey, this family office was really helpful. He got me an introduction with this bank, with this company, and that's creating a very good flywheel for the family office to get better deals. So from a long-term perspective, it just makes a lot of sense for a family office to maybe start with a small team, but have someone on a senior level on there and get into the networking, get into the portfolio management things because that is then going to create an entire positive flywheel for you to get the best deals in the market.
Interesting. Sarita, earlier in the conversation, you had mentioned that family offices are looking to invest from the point of view of diversification. One of the
Right.
strategies is that.
Yeah.
Have you noticed whether the family offices are restricting their investment thesis to strategic value adds with their existing businesses, or are they open to even funding businesses that are not related to their existing core businesses?
So I typically see that they invest in other businesses and not, strategic investments. Like I said, the objective itself is diversification, uh, and in the Middle East, a lot of family offices come from oil money, so it also makes sense to diversify. Varun's experience may be different from mine here, but strategic is not so much. It's largely other businesses. And also, I think with investing in strategic assets, there is one challenge. The uh, investee company may look at it as a threat. There may not be so many opportunities to invest in make a minority investment in a strategic company. So, in fact, this week there was this announcement, Hero Motocorp, which is the world's largest top two-wheeler maker, invested in Arthur Energy, which is a electric vehicle startup. I don't think we come across a lot of these because because the investee company is very off showing its books to the investor who's a competitor also in many cases.
Very interesting.
Related businesses, it does make sense, but it can't be pure play strategic very often.
Varun, what's been your experience on this point?
I think I agree with Sarita on this. In fact, on the strategic point of view, I think we've seen founders get stuck because of this, the family office or the company coming in as a strategic investor early in. What we've seen happening is that everyone, more than the founder, it's like the other VCs and all then take a view that the exit is already set in play, and that whoever is the family office who's taken the strategic position is going to acquire the startup. So a lot of these guys then, because of that, aren't ready to fund this startup. And what we've seen is that by virtue of this effect being created, the family office or the strategic investor has to then acquire the company as it goes ahead. So agreed completely with this. Like it's very difficult. Like if you are a family office and if you are doing a strategic investment, then I think it's actually a disservice to the entrepreneur and the founder, because the market is going to look at it is like this deal is set in stone, and that this is the path that the founder is going to go on. So that is, I think, so something that an entrepreneur should also be very careful about. We've seen this play out. The other way, what we have seen is a couple of the family offices, more nuanced, who spent some time in the US and who've also made money through IT and all. They are building platforms, and where the goal is that to acquire 2-3 of these startups in the tech space, get them to merge together, use their synergies, and then list them out. So that's a complete different story altogether. But then even over there, what happens is that the exit is already set in motion. So it's very it's something that founders need to think about very carefully when it comes, like how are the other investors who are going to come and view the family office or the strategic investor investing in this current round.
So, Samar, I want to add one more thing. There is one more, option which is beginning to emerge. We've seen it in some places. Some family offices come together, pool their resources, they hire a professional management team, and then they are able to invest in these companies where there is a strategic angle and the perception of risk is limited. So that's also an option one can evaluate. Also, going back to the previous question where Varun mentioned that family offices are evolving and they are hiring portfolio managers and having proper teams take care of the investments. Tech is a highly specialized sector in most cases, so that's completely required. And the option I just mentioned, where some family offices pool their resources and hire a portfolio manager, I think it solves a lot of problems in one go.
Sarita, have you seen, do family offices like to take board seats?
I haven't come across many such investments because the ticket size is usually small. And also, in the last few years, I've realized that not everybody wants a board seat. People want an observer seat now because of the liabilities which come along with board representation, board membership. So Yeah, because the trends are also evolving. I haven't come across many options.
Uh, Building on that thought,
I think
unfortunately,
someone
few.
I can just add one
Please.
new perspective, which I was speaking to someone else because there have been couple of companies which actually went under where the VC investors had not exercised their boot seat, and I think the flip of this is that what happens is sometimes the board gets crowded with competing VCs who have different exit horizons and different ideas.
Hmm.
So I think to get a board seat, I think what one needs to understand, I think our founders needs to take a call as to who is most aligned to them and who will add the most value in a board meeting. Because agendas will change for any VC investor, and that makes it very super critical for them to be able to be in a position that the one who's most aligned to their incentives is on the board. So this was something which I just had a conversation with someone, and I thought it was very interesting. So I thought to point it out.
Very interesting. It's interesting you guys touched upon the corporate governance issues. So, unfortunately, over the last 12 to 18 months, as the funding winter has set in, so has, sort of such few skeletons in the closet also have come out with respect to startups being accused of fudging numbers, etc. How can so many professionals on this do family offices have the competency to identify red flags? What can they do to be able to identify red flags with respect to corporate governance issues in the investee companies?
No, it's difficult for a family office to do it on.
I think Varun is facing some internet issues. Maybe I'll pitch in here. And I agree with what he's saying. I think it's difficult for family offices to have the skill set to actually look at corporate governance issues. That's why I did mention that LP route is the best route for them. And you said that there are these uh, scams coming out, or I'm not sure what word exact word you use,
Skeletons.
skeletons coming out. But you may have noticed one of the recent cases, they had everything going for them, including they had the best auditors, they
Hmm.
had all the corporate governance practices in place, and yet my understanding is that it was pure greed that the company failed. And that's something which is happening more and more lately, because all the standard practices are being followed in all sizable good companies. Sorry, Varun, I took over since your screen
Thank you so
froze.
much. Some issues with the internet. No, but like what I was
Hmm.
saying is, I think you will have it's difficult for family offices to do it on their own because usually a family office rides on the coattails of a venture capital who has a larger team, who has more specialized professionals like a dedicated legal person, a dedicated account person who will coordinate with the accounting firms and legal firms to get the numbers vetted and all. So I think it's difficult for family offices to do that. I think there is a need, that's why, to have a professional team who has the time to basically coordinate with these folks and has the experience, because there may be some diligence issues which are solvable. Some, what we have seen is, like, especially when it comes to tax and all, the founders are not the best at understanding the tax complexities, and to be honest, even the tax professionals sometimes get it wrong. So it's not their fault. So I think that is something that is been a challenge. But what it is, I mean, there's always that these things will keep happening. I think the idea is to be vigilant. I think I mean, you can look at examples across the world, including something like a Theranos and an FTX also that happened. So it's not a
Hmm.
one-off thing. It will keep happening in cycles. The idea is to keep learning and keep developing tools to better monitor and have the right people who keep monitoring these things.
Awesome. So I'll just switch gears very briefly in terms of, so one of the things that came up very interesting, I thought that was so family offices that have made their money in technology companies, right? As an example, Airtel's entire growth has been embedded in technology. But what about those family offices who have had very little prior exposure to technology companies. Are you seeing more and more participation from them in wanting to invest in technology companies?
So
Or is it still
technology,
restricted only to historical wealth being created through technology? Only those people are entering into technology bets.
so technology is the buzzword these days, and every new age company is related to technology in some sense. It's whether it's consumer tech, fintech, auto tech, you name it, everything is tech these days. So I see investments, but again, it's a highly specialized subject. And while people want to invest, I don't see as many investments from people, families who don't come from a tech background investing in tech. I see investments in crypto and the likes, but um, which honestly I don't have much of a view, but not in other segments.
Varun, for the many professionals, consultants, and lawyers on this sort of audience, what are the 3, 4 areas where their expertise, consultation services can be of value to family offices? What can they pitch to family offices?
No, I think there's a lot that they can pitch, especially in terms of how to structure the entire pool of capital, which vehicle will make sense. I think that's one of the most critical points where all the lawyers, the accountants, and the tax folks need to be on the same page. What we've seen is that in certain cases, some of the family offices that we know had invested into SpaceX and Stripe, which are international startups. And what happened was that the tax authorities started asking questions: that how did you get investments in this? What have you done? All and what all can you explain the structure and all? So I think there's a big play over here for a lot of the lawyers, accountants, and tax folks to get together and come up with structures that can help protect family offices when they try to do these investments, especially in international companies or in companies which are in other jurisdictions than their home jurisdiction. Because I know every legal system, every tax system will ask this question at a certain point of time as to like what is the idea to invest somewhere there when the opportunities are here. So that definitely is one of the most critical areas that they can play a role. The other role is, I think, what we are also seeing is that uh, we are seeing that a virtual CFO has become a new service line that people offer for founders, and I think that could be something that can also come to the family offices, especially in terms of like whenever they need to file the compliances and need to take care of things over there. I think on a deal by deal basis also there's a scope to have experts and consulting assignments on certain aspects, especially when things are more in terms of a regulatory arbitrage play where the law is not where the law is silent, and there's a lot bit of gray area here. So I think lots of avenues for service providers to play in this arena, and I think it's just the start.
One of the interesting observations that came out in a conversation I was having with somebody else is the generational gap in terms of, let's say, the wealth being created by an older generation, and now the new generation entering that same family business, wanting to pour into technology. So we as service providers, should we be building our relationships via the younger generation or pitching directly to the older generation? Sarita, what do you think?
I believe it's better to pitch to the older generation because they are the ones still writing the checks. So, as much as the younger generation wants to invest in technology, they have to get the approval of the people who build this wealth. In fact, I
Very
see this not just in technology. I see this in even consumer companies and any company which is slightly different from whatever is historically happening. So the new young folks want to go ahead and create something of their own, completely new ideas, but the check size which the patriarch writes is very small, and this young guy has to go and find money from VCs.
Very interesting. Okay. At this point, I would love to sort of open it out to the audience for questions for the panelists. Tan, if you could just facilitate the chat if it by chance not open.
Yes, definitely. If anybody has any questions, you can either mention it on the chat or you can raise your hands, whatever you're comfortable with. Okay, I think we can continue the discussion as and when questions come.
Sure.
We get those.
Great. So fair enough. So Varun, for you, what would having with your experience having facilitated and invested in multiple deals, can you name top 3 good characteristics of good deals? And Sarita, for you, my question will be from your own experiences, can you provide 3 red flags which now you have developed as an acumen ki bhai, the moment you notice them, you sort of tend to stay away. So Varun, first for you and then Sarita to you.
I think in terms of what it makes a good deal, I think the first thing is basically the valuation and how rich or how cheap it is versus to what is happening in the market. I think that is something that you need to be very careful about and see whether there's a margin for the error and the margin to recover the money in the next round that happens. We've seen a lot of absurd valuations, but I think if you really want to make money, it's better to wait for the right deal, because while everything else could be good, if there's not enough room for the valuation to expand, then you're not making your money. I think the other second thing that I would say is everything, especially in tech investments, boils down to the founder and the founder passion, the founder drive, and founder grit. And I think that is where most of your questions and most every all kind of conversations should rely on. Understanding what the founder's vision is, what is his inspiration, does he have the pedigree to put in the efforts to make things work. So that's the second thing that I would look at in terms of whether it makes sense for a deal to go through or not. And the third thing I think is just look at what is the margins, because that's something that everyone has forgotten about. Everyone talks about GMV, everyone talks about AOV, but when it comes to just even a fundamental gross margin and unit economics level, it's just all over the place. And I think it's okay if the margins aren't there today, but there has to be a story, there has to be a vision that the margins will improve, and it should be something that is at least believable. And I think these are the 3 things that I would say that someone needs to keep in mind while evaluating a deal.
Sarita.
Yes, I think Varun answered the question in some form. And the only thing I would, keep in mind is corporate governance issues. When we are talking about tech companies are often disruptors. So their thought process, their way of working, everything is new to us, and it's not easy to figure out what is right and wrong in that case. But yeah, and I'm not going to claim to know the answer here when the smartest of the fund managers have failed. So the solution is to diversify for a family office or a fund manager, and there is no good way of knowing, right and wrong when you are investing, other than some of the points which Varun just mentioned. So, if I can draw an analogy here from movies, I would. Shah Rukh Khan, who's very popular in this geography as well as in India, he once said that nobody wants to make a flop movie. It's a investments as well. So there is no right answer, but I would be very mindful of corporate governance issues. The founder has to be good, and yeah, they have to be genuine more than anything else.
Sure. Few questions that have come up from the audience. So, from Shami, she's asking that, so while the VCs are so focused on tech and deep tech, what are the non-tech sectors that family offices are evaluating, which can be a good differentiating factor for non-tech entrepreneurs? Varun, for you?
I think consumer is a big space that a lot of family offices understand. It's easy for them to understand well. So consumer, D2C, food. We've seen investments a lot in restaurants, cloud kitchens, and these models. So I think consumer is the space that is another that is always in flavor, and it's also because the profit pools are there, and there is stable cash flows that will come from there. So I think that is one area that we see. Family offices are very comfortable doing deals which are in the non-tech space.
Sarita, I mean, one of the questions Kenny has asked that within tech, uh, what are the emerging themes that family offices are probably understanding and taking bets on, whether it's artificial intelligence, whether it's IoT, whether it's blockchain, SaaS? Do you feel they have the understanding of these subsector dynamics? And what are
So
the emerging themes?
consumer-led stories are the ones which I see are invested in quite frequently. Like Varun was talking about food tech, cloud kitchens. That's something I see that in Middle East there is a lot of appetite for, and yeah, consumer-driven businesses is something which family offices or small investors are looking at. But again, AI, SaaS, I am not so sure about that. In fact, I would suggest that small investors should stay away from deep tech, space tech, AI. These are all evolving at this point. So I think consumer stories are the easiest. Consumer
Varun,
tech.
your thoughts on this?
So, I mean, I think because of what happened with Web3 and crypto, people are still, especially family offices, are slow to take to AI. I think they're still in a wait and watch mode. But I agree with Sarita. I think they should start focusing on things that they understand, which is much more easier. As far as IoT is concerned, I've seen a lot of family offices not touch IoT just because technology changes over there. There's regulations involved. There's a lot of things that is involved with IoT. IoT is sometimes asset light, sometimes asset heavy, also depending on how it is placed. So I think in terms of like the tech side, I think consumer tech is one side where we've seen a lot of investments. I think B2B e-commerce is another side where and B2B e-commerce platforms is another place because traditionally they understand B2B. That's something as a story that they understand very well. I think fintech is another other side because especially when it comes to supply chain financing and something like that, they've seen it work, seen and understood what the journey is there. So that's where we are seeing some themes emerge.
Okay. Haninder has put forth a very interesting questions in terms of theoretically technology has a global application, right? And the market for technology is global. Yet, as family offices where predominantly the business and wealth is concentrated on certain geographies, have you seen them invest in tech ventures beyond their own home countries? And how do they get access to those deal flows? Sarita, for you
Absolutely.
first, probably.
Sure, sure. So from a Middle East perspective, I know that family offices invest in the US and UK, and they are okay with the geographical barriers. But when it comes to India, where there is a currency risk, legal risk, etc., they are
Mm-hmm.
not so keen to invest. So I think the question is not so much about technology, but
I think we've lost. Varun, do you want to step in the meantime?
Yeah, sure. So basically, I think we've seen this happen, and uh, family offices do invest in other geographies for sure. I think in terms of how this happens is it's mostly the local advisors in these geographies bring deals to these family offices, and that's how the investments happen. But it is something that I've seen it quite frequently happen. Like I said, we know family office invested in SpaceX, Tesla, and Stripe. So it's pretty common that it happens. The only thing, like I said, the only thing that needs to be kept in mind is what are the host country regulations that are there. If that is fine, then I think it's much more easier to do everything.
Welcome back, Sarita. I asked Varun to fill in while you were facing internet issues. But from a deal sourcing perspective, are these global deals sourced via investing in LPs, or what's the way to directly source these deals for a direct investment?
Sourcing for direct investment is almost very difficult, to be honest, because there is so much. I mean, there is so many barriers that are there that it will be very difficult. I think by being LPs in certain funds, sure, you can get some access, but again, that access won't be good enough. I think the best route is to network with advisors or investment bankers in these geographies, tell them what you bring to the table, what value add, and then you'll get better access to deals that where you can directly invest in other geographies.
Sarita, your experience? You're on mute, please.
So sorry. So I could still hear while you could not hear me. And what Varun answered was pretty much what I was trying to say. That I see investments in US and Europe happening from here, and the question is not so much about technology which transcends border, but it is about the risk which comes with geographies. So Middle Eastern investors are not still very keen on investing in India, or they're just opening up to it, is my sense, because of the currency risk, legal risk, etc. And I think this year we may see some new dynamics there. But coming back to sourcing of deals, I feel that most of these family offices are investing through LPs.
Okay. So now last question that I'll take from the audience. And probably I'll just try and rephrase it as well. Are you seeing family offices set up corporate accelerators, corporate incubators? Is that a structure where they want to fund or take many bets in a particular sector or theme? Is that the structure that you're seeing open up?
I have seen very large investors go for incubators, or have large portfolio of investments, but it's quite uncommon.
Varun, your experience with this?
I think it's mostly who the companies who do that and see benefit in that. But family offices, they would rather do it on with, because it's their own money. They would rather do it with as a separate vehicle altogether.
Okay. What would be the vehicle if they were to evaluate one such thing?
I think it depends on what the local fund structure is. I think that it would ideally be in a fund or an LLP, depending on limited liability partnership. So I think that is something that is subject to each jurisdiction will have their own structures over there. But it would have to be like a pass-through vehicle or a partnership kind of a vehicle.
One of the very interesting questions that Haninder has asked. So, are you seeing global networking amongst family on offices? Are they coming together to form an association of sorts to basically share deal opportunities with one another, and sort of almost something like just as AngelList or Let's Venture platforms bring together pools of individuals to together invest? Is that something taking shape amongst family offices?
I haven't really seen that. It's more driven by fund managers who go to family offices and ask them to invest in the fund, and that's how they come together, and not the other way around.
Cool. Okay, so I'm mindful of time. I think this has been a very insightful conversation. Thank you, Varun and Sarita, for sharing your experiences with the participants and the audience, and again, some of the great questions as well.